Hello, welcome. Thank you for connecting today for our first webinar 2024. We think there is a lot to discuss with respect to the outlook in a new world with the expected rates normalization. I'm here today with Filippo Lanza, founder and portfolio manager of our HI Numen Credit Fund. Of course, last year wasn't easy for the fund, while the market saw a big rally in the latest 2 months. This year it started a little bit with some volatility, with a different behavior between the first and the second week. Today we got new data from China that brought the market down. So I think we have a lot to say both on the macro and micro side. So Filippo, please, I leave it to you.
Thank you, Laura, and thanks everybody for being here for the first update, first webinar of 2024, and Happy New Year to everybody. I would start the first slide we dedicated to what we think is a consensus right now, and which is quite strong, similarly to last year, but very different in terms of the directions. And I think differently from what we've seen in the past. This time the consensus encompasses both macroeconomic variables, but also geopolitical variables. So obviously there's a big expectation and a conviction there's going to be a soft landing. So basically the economy will slow down a bit, unemployment will go up, while inflation is going to decrease much more significantly. So eventually the economy will keep on going, both in US and Europe, but inflation will come under control. And because of that and the reaching of the idealized 2%, central banks will be allowed to A, start cutting rates, and B, possibly slow down the quantitative tightening, and if anything, restart QE if and when needed. Obviously, the expectation into the year end and the beginning of the year were very sanguine. The expectation was for the Fed to cut in March and the ECB to follow suit. Obviously, in Davos, there's plenty of central banks speaking, and every minute there's a new statement, but there is quite a lot of pushing back to those assumptions. And the number of inflation, whether it's from England today or from US, we've seen in the last couple of weeks, seems to be pointing to a much more sanguine performance of the economy and inflation outperforming. So that's a first consensus, a big bet on central banks. It seems the reality and the statements is quite far away from the consensus already. On the geopolitics, I think is where we see, again, lots of positive and optimistic expectation. Everybody thinks that war with Ukraine will kind of degrade in terms of intensity and possibly open up to some sort of ceasefire, but definitely not escalation. And very much similarly for the Middle East, where the atrocities that we're seeing on both sides of the enemies, whether it's Hamas or Israel, and what happened there seems to be believed by the market to stay contained. So Iran will not be involved, Lebanon will not be involved, but we've seen it already now with the attack from the Houthi in the sea off the coast of Yemen and the impact on the Suez Canal. It seems very much that global trade will be impacted, and that's within a context where the Panama Canal already is suffering for bottlenecks due actually to the water levels due to climate change. So overall, yes, Middle East may not be escalating, and to be honest, the price of oil and gas in Europe seems to be reinforcing the expectation. But at the same time, I think there's going to be quite a lot of trade disruption globally. Obviously, then there are expectations about the electoral cycle. There's lots of election going through. We have the European election in June for the European Parliament. We have the presidential election in Russia in March, and then obviously the big elephant in the room, which is the US elections in November of 2024. Not to mention India and Indonesia as well. So it's going to be lots of elections. Obviously, the biggest wild card is Trump. Again, the expectation is going to be a bit of a positive deja vu of the previous election in 2016, where Trump actually managed to trigger a massive rally. But we like to point out that is very different now, because the economy that Trump has inherited now is very different from the one he inherited in 2016. I mean, we have passed lots of deficit expansion, budget expansion due to COVID on one side. On the other side is inheriting a very conflictual world where US interests are very much ingrained, whether it's Middle East, whether it's Ukraine, Russia, and whether it's China. And then obviously the expectation is that China eventually will be able to slow down, but still maintain a decent amount of growth. Overall, we think lots of those assumptions are quite optimistic, and the market is pushing back to that. And because of that, we kept a relatively, conservative positioning. We like to be long the short-end rates, but not the long end. We actually like to be short some fixed income, especially where there's a lot of debt, like Italy or China. And at the same time, we've been maintaining a negative stance on equity, because all this consensus coming through market levels which are very high, whether it's equity or credit or fixed income. We are kind of the high upper end of the range of valuation that we've seen for some time. So we think overall it pays to be a bit negative, and we started the year okay. We are up around 1.5% probably now, and vast majority of that comes from our bearish stance. Laura, move to the second slides on Italy. Obviously, Italy is a big thing for us, obviously, because it's a bit of a tip of the iceberg for the excessive debt and deficit in the world, but is in very good company there, whether we're talking about the United States or China or even Germany and UK in terms of their deteriorating dynamic. In this chart, we put the yield of the 10-year US BTP and bond. And what we like to show is that, apart from the last, kind of 10 years of QE, bonanza, if you want to call it like that, from 2014 to now. Obviously, if we go before that, there's a lot more sensitivity of Italy to its own dynamics on that deficit, which clearly have deteriorated since then, and obviously on the political pitch. One thing which is very important for us when we come down to Europe is that Europe is much more fragile than what it used to be pre-COVID and even pre-QE. And the reason is, yes, lots of things are being sorted out, like the banks and so on, but at the same time, Europe is having a real issue with the energy supply from Russia, a real geopolitical issue with Russian invasion of Ukraine, and obviously the threat of Trump walking away from NATO. So if we look at the last 20 years and say, okay, what is most relevant for us? Is that the last 10 years of QE, or is the pre-QE world? I would say more the pre-QE world. And if I just look at that, I think it tells me two things, this chart. A, we're going to have a lot more volatility, number one. And then number two, it tells me that the valuation of a lot of the fixed income in Europe are very, very expensive. Obviously, if we, for whatever reason, see the ECB coming back and going back to QE or stopping QT, will change our book massively. But as of now, our feeling is that not only the central banks don't have the luxury to cut rates or even reverse or slow down QT, but actually they're going to keep on going with their path, at least for the next few months. And every month counts because there is a lag cumulative effect of those actions. So on that, we are relatively negative. We have a short position on BTP. We tend to be short countries which are very levered, like Italy, China, and obviously we're very opportunistic on the rest, whether it's Germany or US. Obviously we spoke already about Trump, but it is a massive wild card. The one thing for 2024, one interesting thing about the time frame of that is that wild card could be priced a lot earlier than expected, because given how much Trump is gapping away from his contenders at the Republican primaries, there is a chance that actually the contender just resign. And obviously it's a very expensive process and very stressful, and probably is not really helpful to fight Trump. If you're already going to lose, you better be part of the team and the cabinet going forward. So there is a chance that Trump is going to be the only ticket for the Republicans in the next couple of weeks. And that obviously would concentrate the minds of investors and pundits on what it means. Because obviously the polls are there in a clash with Biden, he would win. Obviously, there's many variables still unknown, like there is the outcome of the judicial processes, the possibility for the Democrats to appoint or nominate a different set of candidates. There's a lot of unknowns, but the markets invariably will have to move and focus. Obviously, one big impact will be, what's going to happen with Trump and the IRA or the ESG kind of trade and the whole energy transition. What's going to happen with China? China is already in a very weak position, a big inverted demographic pyramid, lots of problems with their military, and their like a never-ending list of purges that have been initiated from the Communist Congress, where Xi got power effectively for life. So China could be a very weak target of Trump, and that could accelerate a major global recession. Obviously, one big issue is going to be for Europe. I mean, what Trump is going to say towards Russia and Ukraine, and especially to NATO, obviously that could create a massive deficit demand for European countries. Overall, our sense is that if there is a Trump card and the market will have to price it, it could be quite negative this time. It would be the actual opposite of last time. Last time everybody was bearish on Trump, and eventually it turned around, and because the economic background it came in actually was very positive because it cut taxes. At this time, it would be very different because he can't cut taxes and is inheriting a very overextended budget with lots of geopolitical issues that he will have to deal with and is not capable of. So that's something to keep very much in mind. Obviously, not the only election. Like I said, big wild card for us is also the Russian election. We don't know how strong Putin grab of power is, and if there is any challenge to his regime, if it's going to happen between now and the election. Obviously, that's big question mark. If we move on, obviously within this context, our view is that we need to be very opportunistic, which that translates in a decent chunk of cash for a fund. It's actually good to have cash that can be invested in relatively good yielding assets in the short term. Be very much opportunistic on the macro and do a lot of bottom up on both long and short on credit and equity. Obviously, one big thing we're checking is all the geopolitical and those kind of consensus variable. But one major driver that will make us change completely our positioning and market view is if there is a reversal of QT into a QE. We think we're far away from that, but obviously that's one big question mark that we always have open out there. If we move to the specific, obviously there's some position that we like Ukraine quite a bit. We think has been penalized quite a lot into the end of last year. We think Ukraine has possibly one of the most attractive restructuring and recovery stories for the next couple of years. We think will be the target of a proper Marshall Plan. I think Europe realized how strategic it is, so they'll definitely be there to support them. And it's a great market, agricultural and commodity wise. So we think the support will still be there. We think Hungary will eventually be sidelined in terms of the ability to support them. So that's a big thing. We also think China and Russia will want to be part of that. The only real question here is when this disastrous waste of resources will be stopped. Our view has been very much long there that both US and China have a vested interest to effectively consume the Russian apparatus, both from a military and political point of view, to weaken them at the expense of the Ukrainian country. And so that will continue, but eventually there'll be a point where Russia is going to be consumed so much that eventually there'll be some sort of settlement, and at that point we think the upside for Ukraine will be substantial. The way we look at it, it's in a scenario of disastrous escalation, the bonds may go down another 50%, so going to the high single digits, low single digits around 10. And that's the worst case scenario we see. On the other side, if there is a restructuring, a ceasefire, we see a proper upside, 40-50%. if not more. And then obviously in the scenario where there is a regime change in Russia, and or the possibility of US and Europe to seize the assets from Russia to help with the repatriation, obviously that could be substantial. And on that, again, one big wild card would be whoever comes to the White House next, because it could be very different. There's a lot of a stereotypical view on what Trump will do on foreign policy, but the set of questions and issues he's going to face now is going to be very different from what he had before. So what is going to be his position in terms of size of Russian assets? That's one, for example, one big item that I think will shape the agenda on that side. But Ukraine remain along. We like it. Is actually relatively edgeable because I think it's such a call option kind of point there, and it's so highly correlated with the price of the energy complex, whether it's gas or oil, and many other assets in Europe and US. So that's definitely one of the long that we like, and obviously we're following very closely. If we move away from that, then we'll go into another sovereign story that we've been following it. We've been buying it much lower than here since last year. It's played out pretty well. We think Milei is quite eccentric, to say the least, but I think after he'd been elected, he clearly abandoned lots of these more sensational kind of YouTuber showman kind of points on the agenda, such as the removal of the central bank and so on. So he's moving very much to the middle. The IMF likes him. He doesn't have any real support in his Congress, but at the same time, the president in Argentina can effectively legislate unless the Congress intentionally and proactively decide to stop him. So we think because the honeymoon with the electorate, Milei will be allowed to go on with his structural reforms. The Congress will not stop him until the people love him. And as of now, it seems that that's still happening. And obviously the IMF will be there to support him because obviously the IMF has probably rarely met a government so much in line with their macroeconomic orthodoxies. So that will go on. Obviously, it's very much a matter of time. So every day that Argentina can actually rely on its agricultural sector and its commodity sector to pump cash and hard foreign cash into the economy and improve the reserves, then I think will be a good day. And we have this kind of positive carry for Argentina. And if that goes on, I think eventually Milei will be allowed to keep on going with his structural reforms and eventually go through the next couple of months where inflation is going to skyrocket. It's going to be a lot of economic duress for a lot of the social classes there. But we think the risk reward is in favor of that kind of view. We spoke with lots of people in Argentina, and it feels like there is a very distinct desire to make it happen. And Argentina is effectively a dollarized economy anyhow. It's dollarized not at the individual level. So we think there is a decent chunk, and obviously Argentina is one of the few beneficiaries of the climate change as of now, obviously because El Nino will allow the agricultural sector to be really, exceed any expectation in terms of production, and that will be really good. Obviously, it reminds us very much of Greece and Cyprus, with the difference that obviously Milei is a super ultra liberal rather than hard left wing like Cyprus, and the support in this case will not come from Germany or the ECB, but the support will come from the White House because Trump is very much in favor of Milei, Biden is as well, and then obviously the IMF. So Argentina, we like it. We think this is an upside, 50 to 100%. Downside is there, maybe 25, 30% from the current prices. Definitely worth having. And obviously, there is a decent amount of beta in Argentina because of the fixed income, because it's a relatively decent carry, and obviously would follow the overall, picture on the fixed income side, which we think at the moment we're kind of range bound, but overall, we should see some sort of, normalization of rates continuing, and that should support Argentina. If we can we're now moving to Telecom Italia. Telecom Italia is something we've been speaking for a long time. Last year we started buying it into the below 20 cents. It's now trading at 28. We think the fair price is anywhere between 35 to 45, and that should be reached by June, when the transaction of the sale of the network will be executed. Vivendi had plenty of opportunity to stage a proper hard opposition to the deal going through. They decided not to do it, and I think the message is very strong. We think Vivendi will not oppose it. I give like single-digit probability they will make an emergency request from the judges to suspend the transaction, because they would already done it. They choose a relatively soft path, which means they're happy, and they should be happy, because to find a government together with KKR to buy your network and deleverage is the best outcome possible, and that auction has been going on for 5 years plus. Vivendi is also changing their entire corporate structure. They want to capitalize on their assets. So I think in that context, I think if anything, Vivendi may actually be coming down into a peace settlement with the current board, and even possibly vote in favor of the current CEO going forward. What is interesting to us that economically and mathematically, we look at the spreadsheet and the sum of the part and the financing and everything, and it's a no-brainer for Vivendi to participate in a financial consortium that will buy the entire company at around 40-45, and then eventually sell the network to the government, sell all the service company in some sort of merger, which there's been plenty of speculation whether it's Vodafone Italy, whether it's Iliad in Italy, or any combination thereof, and on the other side focus on Team Brazil and trying to sell it. So we think there is a decent chance that actually there's going to be some sort of tender offer, where Vivendi and CDP together control 40%. They may be actually rolling it over. And then they will just literally take it private and then liquidate within 2 years. We think the returns are quite substantial in that case. So overall, we think the downside is beta in line with the market, and we're hedging that with market hedges. On the other side, we see a decent chunk of upside, anywhere between could be 40 up to 100% in the next 6-9 months. Overall, obviously, the benefit from rates going down because the leverage and everything else. So that will keep on going. Let's not also forget that TI will get almost 2.5 billion euro of earnout if the merger with Open Fiber, which is the other fiber optic network, is going to happen. And we think there's a very high chance that will get in place or will get going in the next couple of quarters. So that's TI, a position we still have. Another names that we've been quite involved is Figeac. We got involved during the COVID. Obviously, they are a big supplier to the aerospace industry. We did the first trade into the restructuring. We bought them into the 50, 60 cents on the dollar, and we closed like a good 30% return. We go back into last year when, after the restructuring, the bonds suffer in the overall duration sell off. We managed to buy those convertible below parity, which is pretty unique. Haven't had that luck many times in my life, but it's actually a good starting point. It's probably the first or second largest aerospace supplier in Europe. Their biggest client is Airbus. They got the order book full for the next 10 years. And unfortunately, obviously, there's a lot more demand coming also from military airspace. And obviously, we know governments are just going one way, whether it's in Europe, whether it's in Asia or America. They're just going to have to add military capacity, and the Air Force is one of the most important and most demanding in terms of capital expenditure. So we really like Figeac. We think the bonds are trading around the equivalent of 70 cents on the dollar, 9% yield. Because of the equity and what happened and what we think is going to happen with this company with the orders, we think the equity could easily double in the next couple of years, and that obviously would bring the convertible with them. So we really like it. We think it's a bit of a gem. There's quite a few of those gems coming up in Europe. We don't need to be impatient. I think we'll see plenty. We've seen last year with Credit Suisse. I think we're going to have more liquidity jump kind of events this year. We're trying to prepare for that. And we're going to be looking for, little pearls, little gems like Figeac in the market and buy them for our investors. Away from that, obviously one thing that we've been speaking with our investor, some of you have been with us for some time. Obviously, Banco Espírito Santo is the old litigation and liquidation claim we have with the Portuguese authority. The bonds have been edging up. Part is because of the time that's gone since the expropriation that we suffer at the hands of the central bank in Portugal. And part is because obviously the good bank that was spun off was Novo Banco. They eventually restructured, they then exited the state aid procedure, and they are now in the process possibly to be sold or merged or IPO. So we think, we got to a point where eventually the good bank is about to be effectively liquidated, and the amount of capital that restructure required was a lot less than what was initially calculated, and which was behind the calculation of the bail-in that we suffer. So I feel pretty confident that we should easily get to the liquidation claim, which is in the low 30s, but there's obviously a decent chunk that will get a lot more than that via settlement. Obviously, there's a big litigation ongoing, and I think, given what's happening with the good bank, which obviously is out there in the public, the feeling is that we're getting closer to the end than at the beginning, and obviously we've been there for almost 9 years now, so it's just about time. So hopefully before the 10th anniversary, we may be likely to get some good information there. If we can then move to the next one.
We are done with the slide.
Sorry. So similar to that, actually, was saying, I thought we added on the Monte dei Paschi, but we didn't. But similar to that, to Novo Banco, which is part of, potentially target to M&A in the banking system in Europe. Obviously, we've seen the banking system has been frozen with, pre-COVID and then post-COVID in Europe. But I think we're going to be seeing a little bit more M&A, and banking is something that we like this year. Not much as an absolute play, but more for the M&A play angle. And that's one of the reasons we like BESH, but we also like Monte dei Paschi. We think the bonds are very, very cheap. The equity, not so much, because it's owned by the government. And because of the technicalities, the government could actually do an ABB where they sell enough equity on Paschi, then the new buyer would then be forced to do a tender offer, but the ABB will come at a discount, and then the tender offer will come at a discount too. So that makes the equity less exciting for us. But we think the bonds are very, very cheap, and we're running a long position there as well. So overall, to summarize on the book, we think it's going to be plenty of volatility this year on the macro side. I think on the micro, we are waiting to see the lag cumulated effect of monetary tightening. We think will be negative. So we think we're waiting. We've been very patient. We're running a decent chunk of cash and, overall short position on the market. We are up around 1.5%. And we looking at, exploiting both, single idiosyncratic situations, but at the same time taking advantage of the macro side. Obviously, one big theme, which was one of the reasons why we had a negative performance last year, probably the main reason was oil Brazil. We marked down those bonds to a point where now they are close to 1 cent, 1% of nominal in terms of marking, and they represent less than 90 basis points for the fund. We clearly had the wrong call on the timing and the events, but I think, where we're now, we think the recovery value of these, either via package of security in a restructuring or liquidation, because the big fiber optic stake they got in the Brazilian fiber optic network, we think the recovery is way higher than where we have it now. So whoever buys the fund now has got the benefit of that sort of upside and very limited downside. But obviously the position has been, we've been suffering from. Hopefully, and I'm convinced 2024 will be the year where the restructuring is concluded, and so we get the new package of security. And I think, I have good reason to believe that the recovery will be substantially higher than what we know. With this, I conclude, and obviously we remain open to any question, any clarification on the.
Yeah, please. So use the chat for a question. In the meanwhile, so Filippo, it's clear you are a bit cautious at the moment with respect to the fund. Where do you stand on duration at this point in time?
I think we want to be cautious here, and we think there's going to be plenty of of events, and I think the big gap we see is between the difference between the consensus and the expectations on one side, and the other side we actually see the activity and the statements and the data from central banks or government. So we see a relatively big disconnect there. So we're trying to be cautious, trying to be positioned accordingly, and just waiting to see for the opportunity, which I think will invariably open up pretty soon. I think we may see another couple of events like Credit Suisse last year. So we feel very confident because of that.
Do you have liquidity available to be used?
Yeah. We started here. We've been relatively liquid, which now is actually not that expensive to be liquid, because we can be invested in high quality government bonds with decent carry. So we probably run close to 20% in cash, but we change that quite a bit depending on the opportunity. And then on the other side, in terms of duration, we tend to be neutral to small short here. And on the credit and equity, again, it depends on the specific situation if and when we see them.
With respect to the banking corporate issues, you mentioned, of course, BES Monte Paschi, but do you have an allocation, a broader allocation for the fund?
We had some that we reduced a little bit into last year. Obviously, we were expecting a bit of a correction this year. I think on top of that, obviously we have plenty of supply, so we're trying to be very selective there and adding a little bit. We overall like banks as a sector, but obviously they're going to be very exposed to rates on one side, and the other side we think we have a question mark on how much that sort of lag effect is going to produce in terms of monetary tightening, is going to produce in terms of loan loss provisions and restructuring on corporate side. So we have some, but it's probably a small fraction what we used to have last year at the peak. And then we kind of looking to add opportunistically as we go.
Good. So at this point in time, we don't have further questions. I think we pretty much cover the positioning for the fund and the outlook. So thank you everyone for being with us today. Thank you, Filippo, and we stay available for any follow-up.
Thank you. Thanks a lot. Thanks, Laura. Thanks, everybody. Have a great 2024. Thanks.
Thank you.